Ranking Member Toomey.
Thank you, Mr. Chair, and thank you to Chair Powell and Secretary Yellen for appearing today. A year ago, our economy and markets were roiled by COVID-19 and the government-ordered business shutdowns. We saw extraordinary turmoil in credit markets, and that turmoil threatened the ability of households and businesses, states, and municipalities to obtain the credit that they needed. That kind of turmoil presented, in my view, the very real threat of a full-blown depression that could have taken years to recover from. In response, Congress passed the CARES Act to provide temporary relief to help the country weather a temporary storm. It was really an extraordinary response to an extraordinary situation. And thankfully, it proved remarkably effective, and we are now well on our way to a very strong recovery. The vaccine is being administered at a rate of over 2 million doses a day. States are reopening, and GDP is set to reach pre-pandemic levels at maybe as soon as this month, far earlier than either the CBO or the Fed originally projected. The economy has been in strong recovery mode since last summer when we saw 38% GDP growth in the third quarter, and well before our Democratic colleagues enacted a $2 trillion spending blowout that had little to do with COVID. Congress must not use this pandemic as an excuse to permanently increase the size and role of the federal government. Congress certainly made this clear for the CARES Act emergency lending facilities. These facilities were established to stabilize turbulent credit markets so that households, businesses, states, municipalities could access credit. The intent was clear. The facilities funded by the CARES Act were to be temporary, to provide liquidity, and to cease operations no later than the end of 2020. These facilities were extremely successful in achieving their intended purposes of restoring liquidity in the private capital markets. And in the December COVID relief bill, Congress ensured that these facilities would in fact be wound down by the year end, as Congress had intended and the law required. They cannot be restarted or replicated in the future without congressional approval. In addition to Congress's swift response, the Fed's response last spring was massive and played a crucial role in our ongoing economic recovery. But as is the case with Congress, the Fed also must fight the urge to continue this response beyond its original purpose. Last March, the Fed lowered interest rates to nearly zero and initiated a record expansion of its balance sheet. This accommodation has remained, and by both official forecasts and market expectations, it's going to continue well beyond the point of full recovery. And that raises at least two concerns. The first concern is that the Fed's increased footprint is almost a permanent feature. And if this is the case and there's no eventual reduction in the size of the portfolio, then the Fed's quantitative easing to date would amount to a monetization of government debt. And I certainly hope that that's not the case. The second concern is that such an accommodative stance leaves our economy vulnerable to inflation. The Fed has signaled that its dovish monetary policy is here for a very long time. Its March summary of economic projections doesn't forecast any rate hikes until 2024 at the earliest, and the Fed appears to have no plans in place for reducing its monthly securities purchases. Given the current economic recovery and the recent increases in commodity prices, inflation expectations, and Fed communications, I do worry that the Fed may be behind the curve when inflation inevitably picks up. Final point and a warning. Very, very little of the Democrats' recent $2 trillion so-called American Rescue Plan had anything to do with COVID. It seemed more like a mad dash to claim credit for a recovery that was well underway and authorize as much money as possible to try to fundamentally remake our society to one where the state is at the center of life for many more Americans. It was a partisan, bloated spending bill. It contained stimulus checks for people with six-figure salaries who had no loss of income, expanded welfare benefits that eliminate incentives to work and minimize personal responsibility. There were reparations, as the chairwoman of the Senate Agricultural Committee called a loan forgiveness program that's based entirely on race and ethnicity. There were bailouts for chronically mismanaged states and cities, despite their having record revenue in 2020 and $500 billion in addition that had already been provided by federal aid. And there was a federal plus-up of unemployment insurance that will pay about half of unemployed people more money not to work than they make working. In the long run, those kinds of policies will reduce productivity, diminish economic growth, and that in turn means a lower standard of living for all Americans. And it will exacerbate societal fractures. Fewer people will be paying taxes to support an ever-growing government, And those who do work will increasingly resent those who choose not to and yet enjoy the same or higher standard of living. That's unhealthy for the body politic, for our economy, and for our society writ large. I look forward to the testimony of our witnesses and the question period later. Thank you, Mr. Chairman. Mr. Chairman, I think you're on mute.
Still mute.
Mr. Chairman, if you've got a technical problem here, would you like for me to kick this over to our witnesses and then get back to you? Give me a thumbs up. Oh, okay, then in that case, until we can resolve this technical difficulty, I will recognize our witnesses. I don't have a proper introduction prepared, but if there are ever two witnesses that don't need an introduction, it would be the two folks here, and I think we're leading off with Secretary Yellen. So,
Ranking Member Toomey is recognized.
Thank you, Mr. Chairman. I just have to observe, if you pick up almost any newspaper in towns across Pennsylvania in the last week or so, a prominent story has been recurring all across the state. That is the story of mayors and township commissioners and county commissioners meeting to try to figure out what in the world they're going to do with this mountain of cash that just got dropped on them after having collected all the revenue they expected last year. In some cases, it's 50% of their entire budget. Really, just extraordinary. My question, I'll start with Chairman Powell. And what I'd like to do, Mr. Chairman, is follow up on the conversation we had last week. I want to kind of understand how the recent Fed projections fit together, because in some ways there are some apparent outliers. At least it appears that way to me. What I'm referring to is, the Fed's recent revisions, economic forecasting revisions, have a very significant upward revision in GDP growth. 6.5%, I think, is your real GDP number for this year. Not inconsistent with where a lot of private economists are, but that's a 2.3 percentage point increase. The unemployment rate that you project is only a decline of 0.5%. And the inflation rate, over the course of the full year, you guys are projecting that it will come in lower than it's been for the last 3 months. So on average, for the remainder of the year, you're implicitly projecting inflation to decline. So I think most economic models that would have that big an upward revision in economic growth would have a stronger reduction in unemployment and higher likelihood of inflation. And my concern is, if your models systemically were to understate the progress we're likely to make on employment and understate the risk of inflation, of course, it could lead to accommodative policy that goes too far for too long. So can you walk us through why you have a relatively small improvement in the unemployment rate and a declining inflation despite the strong GDP growth?
I'd be glad to. Let me start by saying that what we publish in the summary of economic projections is just that. It's individual projections that are totaled up and tabulated, really, it's not something we vote on, but I'll address the medians, which are what we publish. So the reason that unemployment doesn't go down further, given the level of growth, is really just that we see participation expanding on it's a different margin. It's people coming back into the labor market, and that actually holds the unemployment rate up. It's a highly desirable outcome. But this was the biggest drop in participation since World War II. That's part of it. There are a bunch of other things that go into it. And of course, there's a good amount of uncertainty around that. On inflation, go ahead.
I've just, my concern is because obviously private sector economists are aware of the decline in the workforce participation and seem to come to different conclusions. But I understand this is an art, not a science. Let me just, because I'm going to run out of time here, direct my next question to Secretary Yellen. But first, on the topic of IMF SDRs, I do want to thank Senator Kennedy for his leadership on this issue. Madam Secretary, as you know from our conversation, I'm very concerned about the issuance of another $500, $600 billion of SDRs in the name of helping poor countries respond to COVID. SDR allocations are not meant to be a source of foreign aid. That's the realm of Congress to decide whether or not to extend foreign aid. And as you yourself have pointed out, this is an extremely inefficient way to deliver that aid, since the money goes mostly to G20 countries that have no need for this. So I'm just wondering why it is that you seem to have changed your position on the desirability of using SDRs for this purpose. And is this a final decision that's already been made, or is it still in flux?
Well, before committing to it, we will certainly, as the law requires, consult with Congress. I would say that the current crisis has increased the need for global reserves, and that's the IMF's assessment. The global economy suffered a very severe collapse in 2020. It contracted by 3.5%. The emerging market and developing economies face considerable external financing needs, and an SDR allocation will help countries meet this need for reserves without forcing them to tighten fiscal policy, which could lead to further global divergence. Now, this is a joint effort of the global community, and there's broad support for an SDR allocation. It's true that rich countries will get SDR. That's how it works. It's tied to each country's quota in the IMF. But many countries have indicated a willingness and desire to recycle the SDRs they receive, either in the form of loans or grants, to low-income countries. And so that will magnify the impact of the SDR allocation in terms of providing resources to low-income countries.
I see I'm out of time. Thank you, Mr. Chairman.
Thank you, Senator Reid from